Well, welcome along to the third instalment of this video mini-series with comprehensive tax planning principal Sean Hughes. Sean, thank you so much for inviting me to host this series. I'm really enjoying our discussions, and we're moving now on to the topic of inheritance tax. And we've been saying all along that, you know, property is a very long-term game, and some people focus too much on the here and now and don't really think further into the future, but it's so important to, and I think there's a kind of reluctance on behalf of some people. It's a bit like writing your will. It's thinking about what's going to happen after your death is some people don't like to consider it, but it's absolutely vital that they do.
Yeah, absolutely. And I think the past year we've had with COVID and everything else brought it into focus a little bit, and more people are considering it now. And you know what's going to happen to this business that I've built up for the last 30 years when I pass away. I don't want to give 40% of it to the tax man. Give him enough during my lifetime with Section 24 and all that. So yeah, looking at how to mitigate the inheritance tax on your death is crucial, really, in my opinion.
So what are the options open to people when they're thinking about this?
Yeah, well, before we go into the options, really, just to talk about the perfect scenario when you pass away for your properties. Really, what the aim of the game is for me and my clients when we look at inheritance tax is for the investor to die with net assets equal to their inheritance tax allowances. So presently, a married couple in England will have £1 million of inheritance tax allowances on the second death of whichever spouse dies second. So if that individual has £1 million worth of property in their name, they can pass that on to their children tax-free on their death. Now, if you're sat there now with £2 million worth of assets, net assets, so market value less outstanding borrowing, how do you get to that end goal of having £1 million of assets? It might not be possible, it might be. So the simple things that people can do, and it's sometimes the simple things that are the most effective actually. Every year, everybody in the UK can give away £3,000 of assets to anybody, but normally a family member, without incurring any inheritance tax. It's called the annual exemption. You get it every year. So married couple, give away £6,000 of assets every year to your children. No implications. Simple. The other one, and it's not that widely used, but it should be, if we're talking about more elderly people, maybe they've still got a good income from the properties every year. Maybe they're making £50,000 a year. Maybe their living expenses are £20,000 a year. So they've got £30,000 of surplus income every year. They can actually gift that to their children, grandchildren, with no inheritance tax, as long as they make regular gifts out of that income. So it's kind of surplus income every year that you're giving away that is completely exempt from inheritance tax. That's a great way of, reducing the liability. Other things you can do, if people are getting married, you can give them more expensive gifts on marriage. They're the simple things. The next thing to look at is giving away a property. Now, it's a bit more complicated because if you give away that property, the investor loses that income for the rest of their life. You can't give away a property but still benefit from the rental income. There's some anti-avoidance that kind of stops that from working. The other downside of gifting is there's usually capital gains tax to pay on that transfer. And also from an inheritance tax point of view, to get it fully out of your estate when you die, you'd have to give the property and live for 7 years after. It's quite hard to plan, living 7 years at any point, really. So they're the simple things, really, but not always the most effective. There's also trusts as well. And when we talk about trusts, we normally mean discretionary trusts. And again, for a 10-minute video, we're not going to go into the nitty-gritty of trusts. But a trust describes a relationship between the person settling the property, the trustee who manages the property, and the beneficiary who ultimately gets the income and the asset. Now, this is good for people who are a bit of a control freak like myself. You can put something into trust, retain control over it, but then pass it on to your children when you pass away or at a different point in time. Now, there's no capital gains tax when you put an asset into trust or a discretionary trust. But they are very complicated. There can be a 10-year charge. There can still be charges on your death, depending on when you made the gift. So that is just one kind of tool in our arsenal of, inheritance tax planning. The other thing to say as well is if you have your properties in a limited company, there's something called growth shares or freezer shares, whereby if the company is worth, say, £1 million at the moment, all that value would be, assessed on the shareholders. Let's say it's a man and wife, husband and wife. The next 10% of value, the next 100k to take it up to 1.1 million, would still be assessed on the parents. But then anything above that, you'd issue freezer shares to say that when the company reaches a value of more than 1.1 million, that income is then assessed on the children. And that is a really good way of having the growth of a portfolio outside of the man and wife's estate. And that's quite a common one at the moment. But on paper, it works perfectly. In the real world, if you're still buying property quite aggressively, like buying multiple properties every year, lenders don't necessarily like children, especially if they're under 18, having these growth shares. So it's really something that you need to look at, once you've got a more settled portfolio, you're not buying as many properties, and, that can be one thing to factor into your inheritance tax planning.
In the video series, we've been talking about the different tax structures that landlords and property investors can use. I was just wondering, when it comes to inheritance planning, is there a difference, is there a bearing on it, whether you've invested in your own name, a limited company, or indeed a limited liability partnership?
Yeah, it's a good question. I mean, certainly between owning the properties in your own name or owning them via a limited company, there's not really any difference. In your own name, you own that property directly. It quite obviously falls within your estate when you pass away. In a limited company, you own shares in a company that owns that property. So indirectly, you still have the value of that property in your estate when you pass away. So there's not much difference there. Having your properties in a limited company might just open a couple more doors to different inheritance tax planning that wouldn't be available if you've got property in your own name, especially if that property is mortgaged, okay? So it does open a couple more doors, but nothing major, to be quite honest with you. As for an LLP, the inheritance tax benefits that some people are claiming that LLPs have in relation to property income are vastly overstated, in my opinion. Some people are saying that once you've got your properties in an LLP structure for 2 years, you qualify for an inheritance tax relief called Business Property Relief, BPR for short. Now, this comes, in my opinion, from a court case in, I think, about 2016 called the Balfour case. And it was this big stately home with different aspects to the grounds. They had some stables, I think, grazing land. There might have been a bit of tourism there as well. And that case, the courts described that scenario as a hybrid structure because they had the different elements to it. And in that scenario, that investor qualified for business property relief. They weren't actually an investor, it was a family, a very wealthy family going back generations. Now that qualified for BPR, and I think correctly so. Now, the investors that I speak to and the people on your website, in the vast majority of cases, are not a wealthy family with a stately home and different aspects to the business. They are purely rental properties, buy-to-let, a lot of them vanilla, a few HMOs or serviced accommodation. That's a million miles away from the Balfour case. So in my opinion, they do not qualify for BPR. And if you look at Section 105 of the Inheritance Tax Act, I believe it's quite clear that, buy-to-let landlords don't qualify for business property relief. So the LLP, in my opinion, doesn't have any great benefits for inheritance tax purposes.
Well, I think, again, Sean, you've just highlighted how important it is to get professional tax advice, because this is all very detailed stuff. It has important implications for landlords and property investors. Just as we close out this instalment, what would you recommend people, what qualifications should they look for in a tax advisor?
Yeah, I think the kind of gold standard is how they phrase it, is being a chartered tax advisor, so a member of the Chartered Institute of Taxation. And one of the big things that I say to people is, if you go to a top 4 accountancy firm, say, and you went to them for advice, anybody at manager level or above has to be a chartered tax advisor in their tax department. There's a reason for that. It's an objective mark of competency. That's why big accountancy firms make their staff who are at manager level or above take that qualification. And if you don't pass the qualification, you're out, you don't work for them anymore. So if you went to a big firm like that, you would be getting advice from those people with those qualifications. Why would investors settle for anything less than that?
No, you're absolutely right. And again, we'll just stress that this video series is just really a kind of overarching, broad brush view of tax strategies for landlords and property investors. We hope that it fosters some discussion. You may have some questions, and then, of course, they can get in touch with you, Sean, if they want to book a consultation with you or get some answers to their questions as well. So we hope you've enjoyed this instalment about inheritance tax planning. And for instalment number 4, we're going to be moving on to stamp duty, land tax, and some of the savings around that. So please do join us as this tax planning video mini-series with comprehensive tax planning continues.